Many of you know I put on my own conference. The consequence of that is that I understand how hard putting on a conference is. It's analogous to herding cats. So I want to begin by thanking the Mining Journal and the Mining Journal staff, the people that put on this conference, and I'd like you to join me in giving the employees here a round of applause, please. Some of you know I'm ostensibly retired. Putting on a conference myself, I had no particular need to fly to London to participate in this one. I'm doing it because I think that what the Mining Journal is doing with the Mining Journal Select has the potential to be the most important mining investment conference on the planet, including, sadly, my own. The idea that the employees of the Mining Journal, the analysts, the editors, the reporters around the world contribute together and screen projects on a global basis to bring you the 100 or 150 best projects in the world, regardless of whether you agree with the criterion, is a spectacular service. The idea that they do that, unlike an investment bank with no particular regional bias, as an example, comparing to apples on a worldwide basis, I think really is the foundation of a wonderful conference franchise over time, which I would like to be part of. So I'm here, you're here. And my talk is, of course, outlook and opportunity. I would suggest that the opportunity can be easily defined by looking around the room and seeing how few people there are here. One of the first mining conferences that I was involved with was the famous New Orleans Investment Conference. I remember in 1981, at the epoch of the grand 1970s bull market, that conference had about 8,000 people at it. If you juxtapose 8,000 people rabidly enthusiastic about gold and mining, and you look at today's rather muted attendance and perhaps muted outlook, you understand something about the outlook should precious metals or natural resources return to favor. Tom described it as a coiled spring, and I think the simple arithmetic around the demographics in this room speaks to that coiled spring. And we're going to talk about that. Now, the opportunities, of course, depend on which constituency you're from. So you need to listen to the rest of my remarks, deciding, as I'm sure you already have, whether you're an investor or you're an issuer. Because I think your outlook is going to be different depending on the jurisdiction that you're from. And we're going to talk about markets and outlooks from different perspectives, mostly a macro perspective. And we're going to talk about it in two broad categories, which I think need to be differentiated at this conference. One is precious metals, where I think that the outlook and the opportunities are very different. And the other is what I'll laughingly call stuff. All the other extracted communities, those commodities which are necessary for the ongoing material well-being of humankind. Because I suspect that rather than having one market, as we often believe we have many, many, many markets. But in particular, at the top line, I think as miners and mining investors, we need to segregate between precious metals opportunities and opportunities involved in the production of goods and services for the rest of humankind. I think I'll begin with precious metals, simply because that's the easiest case to make, and I'd like to get off on a strong foot. Let's look at precious metals from a variety of points of view. The first is, to follow Tom's coiled spring analogy, precious metals and precious metals securities are, in any historical context, way, way under-owned. Whether or not you think there's a reason for it, let's look at the arithmetic. On a global basis, about 1% of savings and investment assets worldwide are involved in precious metals or precious metals equities, which is to say the market share of precious metals and precious metals equities on a global basis is less than 1%. JP Morgan Chase has suggested that the 40-year mean market share of precious metals and precious metals-related equities on a global basis is about 3.5%. So I'll give you the numbers again. 1% versus 3.5% over 4 decades. In the United States, reflecting I'm not sure what, More confidence? More investment options? I don't know. But the same numbers are that 0.5%, in fact, a little less than 0.5% of savings and investment assets in the United States are precious metals and precious metals-related securities. That's down from a 4-decade mean of 2%. If precious metals and precious metals assets merely reverted to mean, demand for the stuff, that being precious metals and precious metal securities, would increase fourfold. And that's precisely what I think is going to occur. I'm not going to stand in front of you and say in a U.S. context that the U.S. dollar is going to hell in a handbasket, the U.S. Treasury market's going to disappear overnight, that the U.S. is going to go to a gold-backed currency. I'm not telling you any of those things. You don't have to believe any of those things to believe that precious metals will do well. You simply have to believe in reversion to mean. And I believe that reversion to mean is both inevitable and depending on how you define it, imminent. By imminent, I mean within 5 years, not 5 minutes. Gold stock investors being notoriously impatient. Let's talk about why. But first of all, I think I hear often at conferences like this, Rick, cut the crap. Just tell me when gold's going to move. As an old man, and I am an old man now, I answer that question by saying 2000. Gold is going to begin to move in 2000. Gold has been in a stealth bull market in US dollar terms for 24 years. It's generated about 8.5% compounded return for 24 years. So when you ask yourself when gold's going to begin to move in US dollar terms, the answer is the year 2000. So then people will say, okay, when is gold going to move more quickly? And we'll address that right now. I believe that the acceleration in the gold price that we've witnessed over the last 2 years is due to two primary factors. The first is the weaponization of gold's chief competitor, which is to say the US dollar. Whether you agree with US foreign policy or not, it's inconvenient for people who would like to resist the external application of US political will, evidenced in financial markets. The weaponization by the United States of the SWIFT banking system, again, whether or not you agree with US policy, is a fact. There are certain countries in the world who resent the fact that there has been an extraterritorial imposition of US policy through the SWIFT banking system. The second fact, of course, is the US government's theft of $300 billion worth of Russian assets in US treasuries. Again, I'm not asking you to choose between US policy and Russian policy. I'm just asking you to understand that if you are a country that thinks that you might run afoul of the US, the fact that the US government stole $300 billion in Russian assets diminishes the attractiveness of US 10-year treasuries in those countries' portfolio. So the weaponization of the US dollar, I think, has had a lot to do with the strength of gold and central bank buying of gold. In fact, the recent strength that we've seen in gold until about 12 weeks ago was driven almost entirely by central bank buying. Many people don't recognize that the inflows and outflows of physical ETFs over the last 2 years was one of net selling by individuals, at least Western individuals, until 10 or 11 weeks ago. The rest of the buying was, in fact, central bank buying. I believe that central bank buying will, sometime in 2024 or 2025, be accompanied by much stronger retail buying, at least retail buying in the West. Why? An examination of history, including fairly recent history, says that gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated savings instruments. I'm not British, I'm not Canadian, I'm not Australian, so I won't talk to reasons why citizens of those countries should be concerned about the maintenance of purchasing power in their own currencies. But the US dollar has been viewed as the world's reserve currency for a very long time, and as an American, I know something about the statistics around it. And I would suggest that a fear of the maintenance of the purchasing power of savers in US dollar-denominated instruments has very real reasons for being there. Let's discuss some of them. The first is the tendency of the US government, and in fact governments around the world, during times of supposed financial crisis, to engage in something that they call quantitative easing. Quantitative easing is a congressional euphemism for counterfeiting. That's simply what it is. If Tom, as an example, believed that his financial situation was untenable and began to print Albaneses, irrespective of whether anybody other than him would accept them, the truth is that that would be regarded as counterfeiting. And in the United States, he would be thrown in prison, unless Mr. Albanese was a congressman, in which case it would be highly popular and he would be reelected. Irrespective, quantitative easing is counterfeiting. It is not true that printing more specious currency units increases the value of the existing units. You degrade those values, and the increasing real price levels we're seeing throughout the United States economy is partially a function of congressional counterfeiting. The second issue that we need to pay attention to, and you hear it, but I'm going to give you some statistics around it. In the US context, remember this is not the British context, the US context is debt and deficit. Meaning that I think we need to be concerned about credit quality as much as anything else. Let's look at the debt just for fun. These are horrific numbers, but I want you to write them down anyway. Substitute T, by the way, for all the zeros I'm going to give you. Writing 12 zeros to get to a T is very tedious. The on-balance sheet liabilities of the US government at the federal level, not the state or local level, now exceed handily $34 trillion. That's with a T. It's true that that number, net of the Fed's own balance sheet, which is to say net of counterfeiting or quantitative easing, is only $29 trillion. That number, the on-balance sheet liabilities of the US government, is increasing by $1 trillion every 100 days. Every 100 days. Think about the probability of paying off the $34 trillion if rather than reducing it, you're increasing it by $1 trillion every 100 days. But in truth, that's not the big problem. The big problem, by the way, you can see by looking at me. I'm not trying to say I'm wholly responsible for the problem. But the big problem in the US is old folks. Because the off-balance sheet liabilities of the US government, which is to say the unfunded net present value of liabilities, exceeds, by the estimates of the Congressional Budget Office, not some cranky old libertarian, rather the Congressional Budget Office, that number exceeds $100 trillion, and in fact grows. And of course it gets worse again. The demographics of entitlements are very, very, very bad. A generation which got credit for a lot of things, the baby boomers, voted themselves a whole bunch of cool benefits, and we forgot to pay for them. And as we age and demand more and more, the number of people who pay them is less and less relative to our size. If ever there were anything that would get you nervous about the efficacy of US dollar net savings, fiat currency savings, it needs to be the interplay between debt and deficits and our ability to service those debt and deficits. But a third concern, I think, is perhaps more subtle, and that is to say the rate of real interest rates, or the delta between the return that American dollar savers get and the diminishment of the purchasing power of the US dollar. The Congressional Budget Office would have you believe in a statistic called the Consumer Price Index, or the CPI. Several people have more correctly referred to it, from my point of view, as the CP-lie. If you believe in the CPI, you believe that the deterioration of purchasing power of the US dollar is humming along at about 2.6%. How many people here live in the United States? I don't think that 2.6% number has been reflected in the basket of goods and services that any American purchases. To begin with, the index doesn't include food or fuel when it's inconvenient. Those of you in the audience can see I like to eat. An index which doesn't include food is of very little use to me. I flew here yesterday, which suggests that an index that doesn't include fuel is problematic too. It gets worse than that, though. The index is hedonistically adjusted, which is to say the people who construct the index assign arbitrarily values to things like the accommodation that you rent or buy or the computer that you employ, irrespective of market prices. They assign valuations. But the silliest part of the CPI is that it doesn't include tax. The idea that a cost of living index doesn't include the most expensive component of the cost of living is an absurdity. I suspect if I didn't have to pay the tax, I wouldn't complain quite so much about the index, but that's not on offer. I've constructed a thought experiment myself going back 5 years where I tried to reconstruct the basket of goods and services that I pay. Sidebar, I don't consider taxes either good or a service, but I have to pay them. So I included them. And my belief is that the purchasing power of my savings and my earnings in US dollar terms is going down at about 7.5% compounded rather than 2.6. Depending on your experience, the delta between your savings yield, I use the US 10-year Treasury, the deepest and most liquid savings product in the world, at 4.3%, and the 7.5% deterioration in purchasing power that I enjoy, if that's the right word, and I'm left with about a 250-point negative delta. So the arithmetic real return on my savings would seem to be minus 2.5% compounded, which is to say that the US government solemnly swears that if I buy a US 10-year Treasury, they will reduce my purchasing power by 2.5% compounded for 10 years. Perhaps the first government promise of my life that I believe will be kept. At any rate, if ever there were something to make you concerned about the efficacy of purchasing power in a fiat-denominated savings instrument, the disparity between the cost of living increases and the returns that one gets, the nominal returns that one gets on savings products, is very evident. And I think that's really the crux of the gold case. The fact that it's an asset that isn't simultaneously somebody else's liability is one thing, but the fact that there are real reasons for concerns around the maintenance of purchasing power in the US dollar is another. Think about how the United States is going to service $120 trillion in on and off balance sheet liabilities in the next 20 years. Think about it particularly in the context of that number on balance sheet increasing by $1 trillion every 100 days. We did something of a similar measure in the 1970s. We did it by inflating away the net present value of the obligations. We did it by reducing the purchasing power of the US dollar by 80% in the period 1970 to 1980. I believe in this circumstance passes prologue. And I believe that the consequences that savers will understand in the same fashion that they understood in the 1970s, that one way that you shield your personal purchasing power is by saving part of your money in an asset that has a millennia of track record in protecting you. I'm not saying, by the way, that you should or anybody should store all of their savings in gold. I'm just trying to say that as a consequence of the facts, the arithmetic that I've given you, the probability is that the market share of gold and gold-related assets in the United States increases from less than 0.5% to 2%, which is to say reversion to mean. And I say again, if that happens, then demand for precious metals and precious metals-related securities should increase fourfold. I'll leave it to you to imagine the impact of that on the gold price. But let's move on from gold. I think I bored you enough with those stats. Let's move on to stuff. I regard all other extracted commodities as stuff. Wonderful stuff. The stuff that's responsible for the lifestyle that we exist today. The stuff that allowed me to fly from Seattle to here yesterday, among other things. And I want to say I've learned a bit about investing in stuff over the last 50 years. And I want to leave a slogan for you. It's one that took me 10 years to learn, and one that cost me a lot in the 10 years before I learned it. That is, with regards to stuff, markets work. The cure for high prices is always high prices. The cure for low prices is always low prices, despite what Congress might think. It turns out that from an investor's point of view, the most important takeaway from what I'm going to say next is that you will be a contrarian or you will be a victim. The choice is yours. If you ignore the fact that markets work and you chase the stuff that's suddenly popular, suddenly highly priced, you will be disappointed again and again and again. If you learn to love hate, if you learn to look to those commodities which are out of favor, and you have some patience, you'll do well time and time and time again. My thesis has become simpler as I age, which is good because my competence diminishes as I age. And my thesis now is look for a commodity where its ongoing available is essential for the maintenance of the lifestyle or the acquisition of the lifestyle that we all aspire to. Where that commodity is priced on a global market at a discount to the total cost of producing it, which is to say, look for an industry that's truly in liquidation, where the material involved is essential for the operation of mankind. At first blush, saying look for an industry in liquidation doesn't make a lot of sense until you come to understand that in that circumstance, if the price doesn't rise, the material becomes unavailable. Let's look at uranium in 2022. The stuff was priced at about $20 a pound. The International Energy Agency suggested that it cost about $60 a pound to make the stuff. So the industry's making it for, by the way, that's total cost, including tax, cost of capital, stuff like that. So the industry's making the stuff for 60, sell it for 20, being dumb miners, of course, trying to make it up on volume. And nobody wanted to be involved in that material. But if you think about it, either the price of uranium had to increase to the marginal cost of production, or the stuff would go away. And if it went away, the lights would go out. Simplistically, you look at a circumstance like that and say, is it more likely that the price increases, or is it more likely than the lights go out? The headline thesis around stuff, I think, is to look at commodities in precisely that fashion. Let's look at oil and gas at the same period of time. There was a time, of course, in the middle of COVID, where the price of oil, very briefly in the United States at least, went negative. But let's assume for a while that it normalized out again around $20. And the numbers are fairly similar. The International Agency suggests that on a fully loaded basis, the entire industry, including state-owned firms, was producing oil for $60 a barrel and selling it for 20. The thesis is the same. Either the price goes up or your car won't start. Which is more likely? Now, a lot of us can find facts that support the narrative that we're around and would like to believe in. Let's look at fossil fuels again. Part of the anti-fossil fuel narrative in 2022 was that alternative energies would replace fossil fuels. In fact, that point of view is still parroted by, as an example, President Biden and Prime Minister Trudeau. In the first instance, were that true, how could they fly 1,000 jets to Davos to tell you to drive less? But beyond that, let's look at a fact. And this is important for miners, both miners who are involved in electricity metals and people who are involved in fossil fuels. In 4 decades, we've invested well over $5 trillion in alternative energies. By the way, I'm not knocking alternative energies. I've invested in them successfully and unsuccessfully myself for a long time. But this is just arithmetic. We have, with a $5 trillion investment, reduced the market share of fossil fuels from a high 40 years ago of 82% all the way down to 81% after a $5 trillion investment. The end of the fossil fuel era is way, way, way far in front of us. It's important when you examine macro facts that you examine all the facts, not the convenient facts. Let's look at some other facts. That is to say, the ascent of humankind. In the last 40 years, thanks in no small part to the mining industry, by the way, the material well-being of humankind has expanded spectacularly. We've reduced the number of people living in dire poverty, or rather, put a more positive way, we have lifted 2 billion people on a global basis from being extraordinarily poor to being merely poor. There's a lot more to do. There's a billion people on Earth with no access to electricity whatsoever. Those people would like to live like you and I. There's 2 billion people on Earth with access to unaffordable or intermittent electricity, and we need to do more. How do we do that? Stuff involved for power generation, the stuff involved in the materials involved in generation, the coppers of the world, distributed power, which is a fancy way of saying batteries, transmission, and the ability to use electricity in the home. In other words, the stuff of humankind, the stuff that we do. So I'm going to suggest to you that as a consequence of rising material living standards, particularly among the poorest of the poor worldwide, that there is an inexorable growth in demand, or at least an inexorable growth in people wanting to be able to demand it. What could derail this? Well, of course, a recession, a global recession or depression could derail it. I'm not an economist, I'm a credit analyst. So I'll let you determine for yourself if you think that we're on the cusp of a recession. Because without it, you have 8 billion mouths in the world, 8 billion people that would like to increase their living standards. And as the purchasing power of the poorest of the poor increases, remember that their consumption patterns are driven by material stuff. When Tom gets a little more money, what does he buy? He buys some little gizmo from Apple. He buys a service. He buys something that isn't particularly material intense. His lifestyle would improve if he threw away more stuff. But that isn't the way that it works for the bottom half of humanity in a material sense. As they get more money, they increase. At the same time, I would argue that the amount of money that we have spent in the last 3 decades looking for the stuff, developing the stuff, building the stuff, mining the stuff, has declined as a percentage of the real economy. I could go commodity by commodity by commodity, but if you look as an example at real deficits in copper and at our ability to add new supply in copper in the next 5 years, the imbalance between supply and demand needs no discussion from me. It is ugly and it is growing. So I would suggest that there have been 3 decades of underinvestment and misinvestment in exploration for and development of the stuff around the advancement of humankind. Meanwhile, incomes have been growing and populations have been growing. This imbalance, I think, will be the story of the next 10 years. Other things have changed, too. I would suggest that the benign period that we enjoyed, 1982 to 2022, the benign period now I'm talking about is a geopolitically benign period where there was less conflict, more globalization in a good sense. That would seem to be over. Increasingly, in terms of the stuff of humankind, the world is beginning to compete and align geopolitically. Nothing that hasn't happened before in history. The US did a great job in 1960 to 1970, increasing our access to resources around the world. The Japanese came after us. The Chinese, the Indians, they want their chance now. So we're competing rather than dominating them. Not a bad thing, not a good thing, just something that you have to consider. A second thing that all of us need to consider is increasing political rents and social risks. I was at a conference not too long ago in the oil and gas business, a global oil and gas conference, where a speaker told us that the total social rent, which is to say off-site capital expenditures, contributions in lieu, taxes and royalties, in the oil and gas business on a global basis were increasing at about 20% per annum compounded. I don't know what a similar number in the mining business is. Perhaps the Mining Journal can figure that out for me. I'm not going to. But I would suspect that the social rents extracted from and expected of the mining industry are increasing at a much more rapid pace than any of us care to acknowledge. And one of the social rents is simply the rent around permitting. There's a wonderful copper deposit in the state of Arizona called Resolution. Spectacular deposit. Correct me if I'm wrong, Tom, but in excess of 1 billion tons, median grade about 1.5% copper, which is 3 times the average mine grade worldwide. That deposit has been stuck in permitting for about 25 years. And I'm not suggesting that rigorous environmental review isn't a good thing. I'm just suggesting that the level of scrutiny that something gets, not just in terms of environmental scrutiny, but all measures of scrutiny, is such that the real costs of acquiring the stuff of mankind is increasing fairly rapidly. And I would suspect that that by itself makes existing permitted producing deposits much more valuable, because the cost of replicating them, even if we were exploring for them, is going up. Not all bad news, though. Not all bad news. There are really rapidly evolving financial structures, which is to say that the source of capital for the industry and industries is becoming much broader. The industry has been less good at capturing them, perhaps because capital markets were so generous to us in the past that we got lazy. But the fact is there's all sorts of new sources of capital out there to go after. One is an evolving retail investor market. Many of you know that I will, for anybody who asks, rank natural resource portfolios. If people email them to me, you may do this at ruleinvestmentmedia.com. I rank natural resource stocks for people for free, for no obligation. I learn a lot more from this process than I teach, because I monitor the database of inquiries extremely thoroughly. And one of the things that's occurred in my own database over the last 5 years is that, first of all, in terms of new entrants to the market, or at least new entrants to my database, 30% are female. 20 years ago, that wouldn't have occurred. 30% of the new people that are submitting mining portfolios to me are female. More than 50% are outside the United States. So we have a global audience, we have an increasingly female audience, and we have a young audience. I've addressed conferences like this for 40 years, and for most of the 40 years, I was looking at the mirror, an old, fat, bald, white guy. And the truth is that the industry seems always to look for capital to old, fat, bald, white guys. 2 problems with this. 1, we're dying, not figuratively, but literally. And 2, the market is evolving right from underneath the mining industry, and the mining industry isn't looking at where the market is, but rather looking at where the market used to be. That's important. Financial structures have improved too. The non-bank financials, the Orions of the world. Sophisticated capital, looking at other places on the balance sheet to provide capital to the industry. A proliferation of capital. Now, sometimes the mining industry doesn't like this money. Sometimes the mining industry prefers dumb money rather than smart money. But the availability of money, smart or dumb, is not as dire as the industry would have itself to believe. And then, of course, the evolution of royalty and streaming businesses. The simple fact that, as an example, an isolated stream of cash flow from silver could be valued at 20 times cash flow, while that same cash flow enjoyed by a copper producer would command a multiple of 6. The ability to do balance sheet alchemy, which is to say, have Wheaton Precious or Franco-Nevada provide a disproportionate share of the upfront capital in return for a piece of the cash flow that is valued differently on their balance sheet relative to the producer's balance sheet, has and will continue to unlock billions of dollars for the industry. I'm going to skip this for a second. That brings us to the reasons for the current malaise in terms of debt and equity securities in the mining business. What are the causes of it? Is it real? And how do we fix those things? In the first instance, I think that the delta between returns on gold and gold shares is easy to explain. The buyers of gold in the last 2 years have been central banks. The retail buyers have been noticeably absent. And the central banks don't buy gold shares. So the strength that you've seen in the market in gold naturally wouldn't be reflected in gold shares because the constituency that bought gold doesn't buy gold shares. And I think that explains most of the delta between the performance of the metal and the performance of the shares. But I think there's other things too, both good and bad. The bad is that the financial services industry and the investors have been conditioned by corporate performance to think that the mining industry is a bad business. Looking back at the decade 2000 to 2010, when the gold price went up sevenfold, the free cash flow per share of the XAU declined. It took real skill for us to generate declining cash flows when the product price of the product that we sold went up sevenfold. Misallocation of capital, misappropriation of capital, all of those types of things. I actually think for the next 3 years it's going to be better. First of all, the management teams that presided over that track record have been mostly thanked and excused, allowed to pursue other employment opportunities. And I think investors, including institutional investors, are holding the industry to a tighter leash, which I think is a good thing. But I think the investors need to be shown. In this audience, I think we're concerned more with the junior end of the market. And there, the difficulty is a little more profound. I would suggest to you that of the 3,000 junior mining companies worldwide, there's probably only 300 that are genuinely viable, which is to say that 2,700 are flotsam and jetsam. Were you to merge every public junior in the world into one company, we'll call that Junior Explorco. In a very good year, expenditures over receipts, that industry would lose about $2 billion. In a bad year, it would lose $8 billion. So I'll leave it to you to decide what the industry as a whole is worth. Should we price it at 8 times losses? 12 times losses? 14 times losses? The truth is that the junior industry taken as a whole is worth nothing. It destroys rather than creates capital. That sad fact, however, belies the fact that 200 or 300 or 400 issuers in that subgroup generate so much performance that they add legitimacy and sometimes luster to a sector that loses $2 to $6 billion a year. When people talk about the dearth of capital, I look at my own efforts in the industry over the last 2 years. I think I've tried to participate in 44 placements. And in something like 35 of them, despite this alleged dearth of capital, the issues were oversubscribed, and I got cut back, which suggests that the industry is acting very, very, very rationally. That portion of the juniors, which are flotsam and jetsam, aren't getting financed, which is a good thing. And those issues, which are high-quality issues with good people and good projects, are being oversubscribed. In other words, the market is functioning the way it should. How much time do I have left, by the way?
8 minutes over.
Oh, 8 minutes over. Okay. Inflation in terms of loquaciousness. Simply this, ladies and gentlemen. I think we're coming into a bull market in precious metals and in precious metals equities. I think we're moving into a bull market in the stuff of mankind. But I think that you have to be extremely selective, more selective than you've been in the past. I think, too, that your expectations of success are diminished by the experience that you've enjoyed, if that's the right phrase, in the last 10 years. And I want you to remember an early mining conference in 1981 with 8,000 attendees, and I want you to look around the room now and see how many attendees there are here. And I want you to think about those two numbers in terms of quantifying your potential upside. Finally, thank you to the Mining Journal. Thank you, ladies and gentlemen.